Great. Okay. Well, look. Good morning, everyone, and sorry for the slight delay. I'd like to welcome you all here this morning to our latest webinar with PwC on measures and supports for business during this COVID-19 crisis. There's nothing normal with the economic environment over the last number of weeks. In fact, a lot of us are trying to cope with the problems as we see them, and today is no different in trying to battle with some of the technology that we've been exposed to over the last number of weeks. We need to take exceptional steps to make sure now more than ever that we protect our businesses where possible and to ensure their survival until such times as these difficult times normalize. And as always, I'd like to remind you that the Chamber is fully operational and here to help in any way that we can. We're working on a number of new projects which will be of benefit and we'll be in touch in due course about those. We'll be also having two webinars next week, one on financial planning and the other on health and safety and well-being during these difficult times. I'm delighted to be joined this morning with senior managers from PwC, Ciara O'Connor and Brian Hogan, who will discuss the wages subsidy scheme and how to manage VAT cash flow. And Billy Sweetman, partner also with PwC, will have some insights into how the financial institutions are responding. So without further ado, I'll hand you over to Ciara to get the presentations underway. Thank you very much.
Thank you, Gerald. And just to confirm, you can hear me clearly now before I begin?
I can hear you, Ciara, yes.
Great. Good morning, all, and thank you for joining us this morning. I hope you're all keeping well during these unprecedented times in which we find ourselves. Our purpose of being here this morning is to share some insights with you and indeed our experience regarding the various tax measures and other supports that have been announced to try to alleviate the pressure that is being experienced by businesses around the country. Obviously, due to time constraints and obvious technical difficulties, we won't deal with live queries during the webinar, but we had invited people to raise some questions with us in advance, and I hopefully will deal with those throughout the presentation. Once we're finished, you will see there are contact details at the end of the slides, and please feel free to get in touch with each of us as speakers directly with any outstanding queries that you might have. So just, Gerald has already introduced the speakers, so I'm going to move straight on to the topics. So looking firstly at the first slide there, really the thing to take from that is really to just see what an incredible 4 weeks it has been that have just passed. And I think it's fair to say we're likely to see many more changes and indeed challenges over the coming 4 weeks and indeed months. So where we essentially find ourselves in terms of the wage subsidy scheme is at pillar 4 there, where the wage subsidy scheme was introduced from the 26th of March. Now, the sort of businesses that have been impacted by COVID-19 are obviously wide ranging, and you'll see on the next slide, obviously you can be a self-employed individual, and in which case, if your business has ceased trading, you would apply to the Department of Social Protection for the COVID pandemic unemployment payment, which is a flat rate €350 payment. Alternatively, if you are an employer, that being either a self-employed individual who has incorporated or an employer of others, there are essentially two options available. Either you're laying off your employees without pay, in which case they also go to the Department of Social Protection to apply for the pandemic unemployment payment, or alternatively, you choose to maintain those employees on payroll, in which case you may be eligible for the wage subsidy scheme in respect of some or all of those employees. Looking at the wage subsidy scheme, and on the next slide, we've laid out just some pillars that we'll look at. First point being eligibility. And so when you're looking at the eligibility in terms of the scheme, first of all, you have whether the employer is eligible. And that's got to do with whether they are experiencing a significant economic disruption as a result of COVID-19. And essentially, the way revenue are showing that is to manifest itself in a decrease of greater than 25% in turnover or customer orders, and that ultimately they are unable to pay wages and normal outgoings fully. And a key query that has been raised on this point is, because it has been clarified that companies can have cash reserves or a war chest, if you like, on their balance sheet, then the query is, how does this work with the inability to pay? So when you're looking at the inability to pay, you're looking at it in terms of the income that is continuing to accrue. So based on the levels of income, if your income's decreased by 25%, or at least 25%, if based on the income that is continuing to come in, you're still experiencing a difficulty with paying your wages and normal outgoings from that income, then you should be eligible for the scheme. Then moving on to the employees, in determining which employees are relevant, it depends on whether those employees were on your payroll at the 29th of February last, and that a correct payroll submission was made in respect of those employees for the period from 1 February to 15 March. Then you need to look at each of those employees, and essentially the employees will sit within one of three categories, which is dependent on their average net weekly wage as determined over a 9-week period in January and February. Where those employees' average net weekly wage is less than €586, then you may be entitled to the wage subsidy for that employee of an amount of 70% of their average net weekly wage, up to a maximum of €410. Alternatively, category 2 employees are those whose average net weekly wage is between 586 and 960. Those employees would be eligible for a flat subsidy of €350. And then for any employees whose average net weekly pay is greater than 960, unfortunately, they are outside of the scheme. I will touch on this in a little bit more detail in a couple of minutes, because I know it's an area where people have a lot of questions. From a practical perspective, the scheme is dealt with online, so it's via an online application via ROS. It makes sense to try to get your payroll submissions submitted early. So because the subsidy is generally paid within 2 days of the payroll submission, it is possible to have received the subsidy from revenue in advance of actually having to make the payment to your employees. So from a cash flow perspective, that can very much work. A key point to remember from a practical perspective as well is to make sure that you have nominated the bank account into which that payment should be made. There were a sizable number of employers that didn't receive the subsidy last week for that reason. So another key point that has come up is the fact that for ease of administration purposes, revenue will likely be paying a flat rate refund of €410 in respect of all employees to their employers until about the 20th of April. But that excess will be recouped. So it's very important that the employer calculates the correct wage subsidy in respect of each employee and only pays that amount based on the 70% limit and the bands that we mentioned to the employee, because the difference between what they're entitled to and the 410 flat rate that may be paid will be recouped in due course by revenue. It might be an obvious point, but there is no tax deduction for the subsidy amount on the basis that it's being repaid by revenue and therefore not ultimately a cost to the business. However, for any employers who are topping up, there should be a tax deduction for the top up. And speaking of top ups, so it is possible for employers to top up the amount that they're paying to employees. But a key point to note is that where the top up amount exceeds a certain limit, that can result in an erosion of the subsidy that's payable. So for an employee whose average net weekly wage, for example, is €586, the subsidy payable in respect of that employee would be 410. The top up in that situation would be limited to €176, or the difference between those two figures. And that has to be input as a gross amount. So that top up is subject to tax. And on that basis, albeit the amount of tax payable may be quite small, technically the entire amount payable to the employee could ultimately be slightly less than their average net weekly wage because of the tax on that top up amount. If the amount of the top up paid is in excess of that 176, then it will reduce the amount of the subsidy payable by revenue by the amount of the excess. Moving on to what we're seeing as some of the most topical issues being raised, I suppose 5 key points to note in relation to the wage subsidy scheme. The first key point is that it is taxable. While no PAYE is being deducted from the payment by the employer, it is a payment that is subject to tax, and Revenue have confirmed that at the end of the year, it would be subjected to tax by way of review. And for anybody who's not in the self-assessment system and paying tax by submission of a tax return, for any employees, the tax due would be collected by reduction in tax credits over the following years, say 2021, 2022. So it is very important to notify employees of this point, or it could be a very negative surprise for them come the end of the year. I mentioned that I would revert to the average net weekly pay point because, again, in the questions that were submitted in advance of the webinar, a number of key questions arose in relation to this calculation. So one very important point is that it does, when calculating that average net weekly pay, you have to include any bonuses or overtime that were paid in January and February. This can result in a number of employees being excluded from the scheme because it can put their figure for the average net weekly pay in excess of that 960. This is unfortunate, and it can show a disparity between employees who might have received their bonus in December versus those who received it in January, February. But unfortunately, Revenue have confirmed that this is how they're going to continue to operate the scheme, and I guess it's to do with the limited time they had in which to put it in place. It also, the calculation of the average net weekly pay also includes any relevant BIK. So you're looking at the gross pay for USC purposes, essentially reduced by the income tax, USC, PRSI, and over that 9-week period in January, February. Another very relevant point that has been queried with us is the question of cash reserves. So I mentioned it earlier, having cash reserves on the company balance sheet won't exclude an employer from the scheme if they have that inability to pay and can show the 25% reduction. But there is an expectation that any such employers that have that level of cash reserves would be making a contribution to top up the employee wages to a significant level. The level isn't defined, but I would imagine Revenue would be taking a look at the level of those cash reserves and have an expectation of the level of top up on that basis. One other point that we've come across as well is that a lot of employers may cease their pension contributions during the period of the wage subsidy scheme, and in fact are prevented from taking deductions from the wage subsidy payment paid to employees. So in relation to employers that might be ceasing those pension contributions, it's important that if your life cover is linked to your pension scheme, that you don't inadvertently turn off the life cover also by ceasing to make the premium payments for that life cover. So make sure that's not the case. Obviously, in these important times, life cover is even more important. PRSI, as you may be aware, there is no PRSI payable on the subsidy, either employer or employee. And in relation to any top-up amounts, there's no employee PRSI, and the employer PRSI is reduced from 11.5% to 0.5%, which is a very significant reduction. There was a throwaway comment by all accounts by someone in the Department of Social Protection last week, which caused a bit of confusion on this. And while we don't have clarification from them just yet, it would appear to be just that, a throwaway comment that was incorrect. And so the hope is that, yes, that we're correct, and the guidance that is everywhere that the employer's PRSI remains at that 0.5% on the top up. And one other point is the fact that eligible companies can suspend the operation of BIK for the period of the wage subsidy scheme. So you don't have to collect the BIK, but it is just a deferral. It would still be payable and collectible at the end of the year. And so that's an important point to note. And briefly, just before I finish up, a couple of other points that might be relevant from the employer tax perspective. So in company cars, where an individual has a company car, it's reasonable to use the January mileage record when calculating the annualized business mileage, where obviously there's a significantly more limited use of the car during the period of the crisis. If the car is not being used at all, or use of the car has been prohibited by the employer, then it is possible that no BIK would apply. In terms of the vouchers, you might be familiar with the small benefit exemption. That's the €500 once a year voucher that can be paid. So for employees who continue to work, it's possible for the employer to split that voucher in two, so they can pay part of it now and part of it later in the year. And you're also presumably all aware that it is possible to defer any PAYE payments due in March and April for a period of time, which can be helpful from a cash flow perspective. There was also some mention of helpful comments around residence rules, but I think they're probably not terribly relevant to the group here. And therefore I won't get into them because I'm conscious of our time. So without further delay, I will pass on to my colleague Brian, who's going to touch on the VAT aspects.
Thanks very much, Ciara. Good morning, everyone. Hopefully everyone can hear me relatively loudly and clearly. So what I'm going to do is I'm going to take you through some measures that might help improve VAT working capital for businesses. So payment of VAT liabilities has been one of the first tax challenges faced by businesses since the onset of the Covid-19 crisis. And the big question really is how have revenue been dealing with this challenge, and what assistance has it been offering businesses? So the payment of the January-February liability really was the initial challenge faced by businesses. And Revenue's response early on was to provide specific relief to the small and medium enterprise sector by deferring payment enforcement action on the January-February return liabilities. So this has also been extended to the March-April period. For those outside the small and medium enterprise category, the position in terms of deferral is more bespoke. And what Revenue are requiring businesses to do in those cases is to file the returns as usual, sometimes even on a best estimates basis, I should say, but to engage with the Collector General or their normal revenue contact directly with a view to making arrangements to defer payment of VAT if necessary for those companies. What we're seeing in terms of clients that have engaged with the Collector General and Revenue in the last few weeks is an openness, and generally speaking, in our experience, and we're seeing that in instances where taxpayers or businesses have sought deferral of liabilities, that Revenue are offering 1 month's grace to taxpayers to allow them follow up on the liabilities that they've returned in their VAT returns. In fairness to Revenue, they have been making a genuine attempt to expedite repayment claims. And indeed, we've seen some clients that have had a backlog of claims of Revenue for periods of sometimes up to 6 or 8 months being cleared very quickly due to the onset of this crisis, which is obviously very welcome. So at least that side of things is moving quickly. In some instances, what we're seeing is Revenue are actually making cash refunds to businesses, which is very welcome, and which is likely the priority really for businesses that are seeking refunds. In other instances, we have seen the VAT refund being used to offset other tax liabilities, and this would be something of a bit of a norm for Revenue, and they would generally seek to offset first before making a cash refund. But what I would say is if you're going to engage with Revenue, it is important to agree whatever your preference is in terms of getting a cash refund or an offset, and understand what would work best for your business and see if that can be obtained in agreement with Revenue. In terms of managing VAT working capital, I think it is important to understand how quickly you can get your VAT reclaim into Revenue. Obviously, the earlier you can get the refund in after the period close, the quicker Revenue can turn it around and the cash refund can be received. So what I would say to that is businesses should be aware that Revenue do facilitate monthly VAT filings for those businesses that are in a constant refund position. If you think there will be a change in our VAT profile over the next 6 to 8 months due to the way your business has reacted to the COVID-19 crisis, and you will be now for that period being in a refund position, it might be worth contacting Revenue to see if they would be amenable to putting you on a monthly return filing basis for the period that you expect to be generating refunds, which will allow you obviously to accelerate your cash flow for VAT refunds. So having looked at the VAT payable and repayable position, businesses are also now beginning to consider the quantum of VAT they're paying and the repayable amount to see if they can be managed effectively. So what I'm going to look at now is consider possibilities for deferring or reducing VAT due and accelerating or increasing deductible VAT. In terms of deducting VAT due, what business could do is attempt to get themselves into a position of having received the debt due from your debtor before they are obliged to have to pay the VAT. Otherwise, what happens there is that you're funding the payment of VAT through Revenue from your own cash reserves. So, as many of you will probably know, businesses are generally either paying VAT on the cash received on monies received basis, or on the invoice basis. And for those on an invoice basis, it's worth remembering that you're obliged to raise your VAT invoice within 15 days of the end of the month in which the transaction takes place. So what that means is you have until the 15th day of the month following the transaction to issue the invoice. What difference does that make? And this example might make it a bit clearer. So if you were to, for example, issue an invoice on the 30th of April, that would be the last day of the March-April VAT return filing period. So the VAT that would be on that invoice would be due and owed to revenue by the March-April return filing date of the 23rd of May. So that's effectively 23 days after you've raised the invoice. And that's regardless of whether the invoice and the VAT on it has been paid or not. On the other hand, then, if you had waited until just one day later and raised that invoice on the 1st of May, a simple 1 day delay of raising the invoice, the VAT that's on that invoice won't be due until the 23rd of July, which is the filing date for the for the May-June VAT return period. So effectively, by managing your invoice flow and just deferring an invoice raising by 1 day, you've actually deferred the VAT payment by 60 days. And you can use that 60-day period to collect the debt from your debtor and pay the VAT. So a simple measure that might help you ensure that you've received your debt from your debtor in sufficient time to pay the VAT due on the invoice. Another thing that could be considered is that some businesses that are involved in the provision of services on an ongoing basis to their customers or clients, or they may have agreed installment arrangements with regard to their provision of services. It is possible for those businesses to issue what are known as pro forma invoices, which are essentially requests for payment rather than a full VAT invoice. A full VAT invoice would trigger the payment of VAT by reference to the date of the invoice, but as I say, a pro forma invoice doesn't do that. It's essentially a request for payment. So what that allows those people to do is that once they receive the payment from their debtor, they have another 15 days from that point to raise the actual VAT invoice, and they can obviously pay. And they are forcing the position really of having to pay the VAT by reference to when the cash is received. So you're putting yourself on a cash received basis, even though you may be on formally on an invoice basis of VAT filing. And again, just sticking on the cash receipts VAT accounting point, the cash receipts basis of accounting is obviously very useful for people because it means that you only pay the VAT by reference to when you receive the cash from your debtor. It is only available to certain categories of business, but for those that meet the criteria, then it is well worthwhile revisiting it to see if you can put your business on the cash receipts basis at this point, and it should only be a matter of contacting revenue to do so, assuming you meet the criteria. In terms of reducing VAT due, then I think the first thing that businesses probably should be thinking about in this climate is carrying out a critical review of their debtors to see if there's a possibility of making what's known as a bad debts relief claim. Like everything, there are some requirements that must be met before you're entitled to make the claim, but where you do qualify, your business is entitled to recover VAT previously paid on those debtors that have now become bad, and it could be useful cash flow. Businesses should also be aware that it is only liable to VAT on the consideration received in respect of the supply they've made. So from that point of view, it's also worth carrying out a review of any discounts or rebates that have been given, or debt write-down arrangements that may have been agreed with clients or customers, to make sure that you've reduced the VAT due by you to take account of discounts or rebates that have been given to your customers or clients, and that you're not still paying VAT by reference to the full consideration on the initial invoice. Okay, moving now to look at kind of input VAT then, and the possibility of accelerating what can be claimed. One way of looking at this sort of thing is to say to yourself that each invoice with VAT on it is similar to a check that you're trying to cash. So every VAT filing that you miss, including an invoice on, essentially adds 60 days to the encashment of that check. Some countries do, but Ireland doesn't allow for the accruals of unprocessed invoices to be included on a VAT return. But what Ireland does do is allow you, once you have possession of an invoice, it entitles you to deduct the VAT that is stated on it. Ireland has introduced in recent times a kind of a 6-month look-back period, which seeks to reverse a deduction that has been taken for VAT on an invoice that hasn't been paid within 6 months. Nevertheless, the point is that you're entitled to deduct VAT when you have an invoice, even if you haven't paid the creditor. So again, it's just worth making sure that your invoicing is all up to speed. Sticking on the invoicing point, it's worth bearing in mind that quite often their invoice is stuck in processing in a business. So for example, there might be some time-consuming 3-way matching process or some other verification process going on behind the scenes in your business that has bottlenecked the release of the invoice. and it has meant that the VAT has not found its way into the VAT return for the business. It might be worthwhile, if you think that is the case, appointing a resource just to ensure that such bottlenecks are removed and invoices that are in the house, so to speak, can be routed into the VAT return, and to make sure that you're getting the benefit of deducting that VAT as soon as possible. Excuse me. Also, what some businesses are considering doing at this point is seeing if they can, assessing their potential, I suppose, to get involved in what's known as self-billing. Self-billing is a process whereby the debtor itself takes control of invoicing or billing on behalf of their supplier. And what this does really is puts control over the entire billing process in the hands of the debtor. So in other words, the person who is due to pay their supplier. And it means that the transaction is occurring within their system in real time, so to speak. And it gives the business the fastest opportunity to record VAT and include it in the VAT return for deduction. So again, if you're able to agree that, it might be something that would speed up the release of VAT deduction. In terms of increasing the deductible VAT, many businesses should consider possibly analysing their expenses to see what that may be included on those that are reclaimable. Generally speaking, I guess in our experience, the amount of deductible VAT included in expenses may not be that large, but under Irish VAT law, there is a 4-year look-back period which allows businesses to reclaim VAT that's up to 4 years old. So included in some expenses, you know, by the time you add up 4 years worth of VAT that might be included in expenses, it could add up to being a nice amount. On some occasions, there may have been foreign VAT genuinely incurred. That too is recoverable through other means, but that should also form part of any review that's carried out. Also then, depending on the nature of their economic activity, some businesses may not have full VAT recovery. So it might be as low as, say, 1 or 2%, depending on the type of business they're in. Many of those businesses may not have carried out an annual exercise to assess whether this rate of deduction is appropriate. And in some cases where they do carry out the exercise, there may be an entitlement to deduct more than what they think is their standard rate of deduction. So in other words, the 1 or 2% of deduction may become 3 or 4 or 5 or maybe even more once you carry out a review and a reasonable basis is established for verifying that higher claim. Again, if you were to do that and you were to increase your entitlement to deduct over a 4-year look-back period, this may free up some nice extra cash. Also on the VAT deduction point, in our experience, VAT can be left behind at the point of importation, sometimes due to ineffective capturing of the invoicing or the documentation that is released from customs, verifying the VAT that's on an import, and that's incurred at the point of entry. So it might be worth, as a suggestion, requesting a printout from revenue of VAT incurred at the point of import for a business for which it's relevant, and reconcile the number on that printout to the amount of import VAT that has actually found itself into the VAT returns of the business. Any VAT that hasn't been deducted again in the last 4 years in relation to imports can be picked up now without too much hassle. Whilst I'm on the topic of imports, it's probably worth pointing out 2 businesses here that for which it may be relevant. That revenue have agreed to waive duties, customs duties and import VAT on goods imported from outside the EU that are used to combat the effects of COVID-19. And to avail of the relief, organisations must use the goods for COVID-19 purposes and make them available to people at risk free of charge. So quite often a hospital or medical practice might be buying in some stuff that will be given to their staff free of charge. I would think in that case they would qualify for that relief. So a bit of a whistle stop, I suppose, through the VAT working capital, but in summary, what I'm saying is businesses should understand the components of its VAT working capital and then assess what measures it is possible to undertake for improving it. What I would suggest is if you have any questions, please feel free to contact me afterwards. Contact details are on the slide, and I'll hand you over now to Billy, who will take you through the banking reaction and some financial management insights. Thank you.
Thanks for that, Brian. Some useful tips there in terms of improving VAT cash flows. I suppose after the initial shock and disruption of COVID-19, where people were scrambling to work out what it meant for them and to ensure the safety of their people, and I suppose they're trying to move to a new working style. the narrative then moved on to cash management, I suppose, and most of the conversations we've been having with clients over the last week is really around that issue of cash management, trying to optimize liquidity, operational cash flows, bank financing, and trying to get a handle on the business supports available. And what we're seeing is probably a kind of a range of initiatives people are deploying, which I've tried to outline on this chart. I suppose number one, some businesses are back to zero revenue at this stage, and for them, certainly cost containment and cash outflow reduction plans are very high on the agenda. So that might be involving a tactical deferral of some orders, elimination of any discretionary spend, trying to access the government supports as quickly as possible. Looking at payment plans with suppliers, looking at the rates deferral for certain sectors. So a whole range of mechanisms trying to reduce the incidence of cost in the business, but more importantly, even reducing the cash outflows from the business. The second issue, and we've had some queries in advance on, was the bank's response to the repayment moratorium. So really there is a general openness from the pillar banks to grant businesses and indeed private individuals a 3-month moratorium on repayments on loans through a fairly straightforward process. So certainly anyone who hasn't considered this, I think it's worth looking at and considering in detail. Also, some people have focused on their business loans, but I'd suggest you also maybe look at your personal loans as well to see, does it make sense to take a moratorium on those to ease the cash flow requirements on you and on your business. In terms of additional finance, some businesses are needing to draw that now at this point, just to tide them over. So those zero revenue businesses who do have ongoing costs are drawing some additional finance. That's probably there's a higher hurdle to cross for businesses to get approval for that additional finance from their banks. Really needed to demonstrate a sound business plan to the bank. Non-bank lenders are also out there as well, so the likes of Link Finance offering loans at this stage with initial repayment moratoriums on them. I'm going to deal on the next slide with some of the strategic banking corporation schemes. But the other sources, of finance, owners putting more money in, looking for third-party equity, disposal of non-core assets, all of those need to be challenged to see, do they make sense for the business? And probably stakeholder management is taking a lot of business owners' time in terms of managing affairs with the likes of the Collector General, their banks, keeping them informed as to how things are going. Auditors, if you're in the process of getting your audit opinion signed and there's going concerns. Pension schemes, in certain circumstances where there's deficit funding for defined benefit pension schemes, employers need to work with the trustees to see what the optimum position for that is. If you rely on credit card companies for inward payments, you need to make sure that you stay on top of the relationship there and to make sure they continue to support you. Relationship with landlords, there's certainly been a lot of backwards and forwards between landlord and tenant as to what is the appropriate solution for a particular business. So that needs management. Your suppliers and the supply chain, making sure that you can continue to get the parts or the goods you need for the business, versus your competitors and your customers, staying in contact with the customers. Your credit insurers, where if you're reliant on credit insurance, or indeed your customers are reliant on credit insurance on you. And regulators, for those of you who are in regulated sectors, you'll need to stay on top of where your regulator is in terms of, for example, solvency requirements or capital, and report deadlines. But all in all, really what we're recommending is people try and draw all of that together into, a 13-week rolling plan. So looking forward the next 3 months in terms of cash and operations, making it very clear to yourself what your underlying assumptions are. For example, when do you envisage that social distancing rules may be relaxed? Because all of those things will impact on it. And as those assumptions change, as we get more facts, then you can alter your 13-week plan on a rolling basis. And certainly if you're looking for additional finance from any source, you need to start thinking about the business plan. And each of the pillar banks has useful guides on their websites in terms of what's required for a business plan in the current environment. Just a quick run through on directors' duties. I suppose there's many competing demands for the limited cash available in limited liability companies. But I suppose it's important for directors to avoid any subsequent charge of reckless, fraudulent trading or fraudulent preference. One of the questions that arose in advance was, drawing the COVID-19 wage subsidy, is that indicative of that you're insolvent, or could that give rise to a charge for reckless trading? Certainly our view, and the view of the likes of Niall Cody, Chairman of the Revenue Commissioners, and say Willie Day, a leading insolvency practitioner with Arthur Cox, is no, it doesn't in itself give an indication that you're insolvent or continue to trade as reckless. Well, we would say it's important that you do have a clear view of your future cash flows, your trading performance and your balance sheet position. And if you believe you're borderline in terms of insolvency, you should maintain clear evidence of your decision-making process. And if in doubt, seek professional advice. There's plenty of professionals who've been through this in the last economic downturn, so there's plenty of knowledge available to support you in that decision-making process. So over the last few weeks, there's been a range of government support packages. As Ciara said at the outset, it started off small and I suppose grew over the course of the last 4 to 6 weeks. My own view is, what's out there at the moment is fine, but in terms of the necessary stimulus to get a meaningful recovery going in due course, we need to see something much more significant in terms of government intervention. But what's available at the moment, I suppose there are a portfolio of packages. So the Strategic Banking Corporation of Ireland has 3 schemes: a working capital fund, a future growth term loan scheme, and a credit guarantee scheme. The credit guarantee scheme essentially is for businesses who, for example, maybe don't have sufficient collateral to get a mainstream bank loan approval, but can get the loan via the credit guarantee scheme. So those 3 loans you access via your own bank. So Bank of Ireland, AIB or Ulster Bank are the main mechanism for drawing down those loans. And at the same time, you need to get your eligibility confirmed with the SBCI. Enterprise Ireland and IDA have put together a euro 180 million fund. So this is effectively a repayable advance. So in other words, a loan with a 4% per annum charge attaching to it. So this is aimed at manufacturing clients and clients in the international services sector. At the lower end of the scale, Microfinance Ireland has a loan scheme now for 3-year term loans up to 50,000 per annum at an interest rate of between 4.5% and 5.5% with an initial moratorium on repayments. So certainly worth looking for. Then there's some small grants that are, might be worth looking at in the current environment. Moving online trading grant from the Leo office for small businesses up to 2,500. And a really interesting one for online, for retailers who want to expand their online presence. So an 80% grant for the costs of between 12,500 and 50,000. So grants of between 10 and 40,000 available from Enterprise Ireland. So certainly worth looking for retailers who want to try and drive sales via an alternative channel. And then finally, some business continuity vouchers from the Leo office, so 2.5k to get some professional advice in terms of business continuity. And Enterprise Ireland have a 5k voucher for financial planning grants. So certainly businesses needing to reforecast and create business plans, they're worth looking at. Enterprise Ireland also have a small lean business improvement voucher to support lean in businesses. So I think that was a kind of a whistle-stop tour through the various supports that are currently available in terms of the COVID-19 wage support scheme that Ciara went through, some cash enhancement measures in terms of your VAT cycle from Brian, and then looking at, well, what practically businesses are doing and the government supports available, which I just went through. I'd like to thank all of you for your attendance on our seminar this morning. Our contact details are on the screen, and if you can't catch them, certainly reach out to Gerald or any of your contacts in the chamber who are working hard to support all of our member companies. Can I finish with the wish of keep sanitized, stay solvent, most importantly, stay safe in the days and weeks ahead. Thank you.
And Billy, just before we wrap up, I'd like to thank you, Ciara and Brian, for taking the time to outline the measures and supports for businesses during this exceptional time. And as you mentioned, if there are any queries, either contact yourselves or feel free to pass your queries on to me as well, and I'll pass them on to get them answered for you. And also, just finally, to remind you that we will be having another 2 webinars next week, one on financial planning and the other on health and safety and well-being during this time. So again, thank you very much for everyone that attended, and to all at PwC for facilitating this. Thank you, and stay safe.
Thank you.